stocks that are keeping the flag flying high for the bulls, at least trying to at this point in time. Sanjay Parekh, founder and chief investment officer at Sohum Asset Managers, is with us on the show today. Sanjay, thank you very much for joining in. Welcome to the show. So you tell us, I mean, first of all, let's get your sense on, headline things like valuations, because the market rally, which was quite ferocious up until, I guess, early July, that's kind of now started stalling. We haven't fallen too much, barely 3% from the top, but it is getting a little sluggish. So what do you think of the overall construct, the earnings, quality of earnings, valuations, and just sheer money flow?
Yeah, hi Surabhi. So basically, your earnings clearly are, not cheap. If we take earnings on Nifty at 950 to 960 rupees for 24, and then move to 25, which would be ranging from 1,070 to 1,100. On 24, we are at 20 times plus, which is not cheap for our interest rates. And clearly, we have to look at 25. And on 25 for our interest rates, if we give 20 times on India's earnings for the character of the, overall character of the market is, then there is clearly upside. But, we certainly in equity, you need at least 12-13% return as a cost of equity. So what we believe is there is some time correction which is possible as we transit to 25. And there could be some time price correction as well. But structurally, we are very, very positive. And we believe that, there could be a 3 to 5% downside. And that would be a very, very good level to enter. And in the interim, you could look for stocks which gives you great opportunities to buy. That's our strategy. Yes.
Hi Sanjay, good afternoon. Thanks so much for speaking to us here on CNBC-TV18. It's been a while since we spoke, and good to see from the time you have launched this fund, you have outbeaten actually what the index has done, the Nifty. And the better part is actually that valuation-wise, your portfolio is cheaper than what the Nifty is trading at. So good on you. But the point is, from here on, where do the opportunities lie? You're fairly spread out in terms of opportunities. I'm looking at some of those stocks that you have in your portfolio. Tell us about the way you'll allocate money first between large and mid caps. As of now, you're still pretty much large cap heavy, right?
Right. So, our framework is that, always we would have at least 70% into large cap. And we move into mid and small cap if the threshold of returns is significantly higher. And internally, broadly, the way we talk about it is, can it double in 3 years? If not, at least in 4 years. Otherwise, we'll be into large cap. That over cycles that I've managed earlier, funds at Nippon or even ICICI, that has been the framework I've been following, and it helps. So here as well, we have more like 32 names, of which 18 are Nifty companies, another 3 are large caps, and then the rest of them are mid and small cap stocks. So we are hardcore GARP investors. You rightly said, our price earning of our portfolio is 14.5 times on 25. Our growth is 22%, and our ROE is higher than Nifty. So that is exactly what we follow, growth at reasonable price for the portfolio as a whole. But we clearly love growth, but we want to buy them at reasonable price. So within mid cap, small cap, the strategy is that look for where the size, critical mass is there. They can move up to the next scale. With comfort on promoters, the size of opportunity is large, and the most important is they should double in at least 4 years. And a lot of them, you've seen in our portfolios on the digital space, or all around in microfinance. We do get opportunities like that, and that's what we seek for. But we don't chase momentum. We look for the right entry point, when we are buying mid and small cap, and don't break the discipline of having the threshold of return that we seek. So that's a built-in risk mechanism we have in our framework. And yet, with less risk also, we've got alpha, as it's demonstrated in our 14 months performance.
Sanjay, afternoon. Reema here. Just to get a little stock specific, Jupiter Wagons is one of your bets. And the stock has done phenomenally well. In the last 1 year, it's up more than 300%. Whenever we think of railway wagons, our mind typically gravitates towards Titagarh wagons. Now, Jupiter Wagons has had a name change, so that's also adding to that confusion. But take us through the thesis here. Why did you bet on Jupiter Wagons, and how long will you let it run, your investment, considering the kind of returns it's already given?
Yeah, so we bought this in a QIP, which was at 104 rupees, I think 4 months back. The overall size of opportunity was clearly larger. The number of players who have this capacity was lower than the demand, and the demand would far outstrip the supply. Clearly, we could see that. This company has Tetrawagon as a joint venture partner, which is a European major. The domestic promoters own 52%. The Tetrawagon owns 20%. And they are also moving ahead in terms of JVs in the railway segment further in certain components required in the railway segment. So clearly that was an opportunity which was pretty large. The growth in terms of EBITDA, we bought at a market cap of 4,000 crores. They would do 425 to 450 crores this year, move up to 550 to 600 crores next year. Very, very strong order book, very efficient in terms of margins, very disciplined, not having major debt. And the entire expansion plan in the next 3 years would be purely from internal accruals. So that's where we bought in, and of course it's gone quite fast, but we like this stock for longer term.
No, that's well put. Sanjay, hi. You said you don't want to chase momentum, but sometimes momentum chases you, right? Jupiter is a case in point, as you said, 104 to what, 250, 260 in a few months.
Yeah. I mean, I'll be very honest, Prashant. We have a very strict discipline of fair value that we put for 24 and 25. And our fair value for 25 was coming at 250, which has happened in 4 months. So it does happen, markets sometimes move too fast. And that's where the discipline comes off, even if at times you want to book profits, hold partially. And that's what we do very, very objectively in a detached manner. We have our assessment of value. And then, we just, once our value assessment is done, then we act based on that value that we arrived at.
Using this as an example, because buying someone is hard, but selling is sometimes considered an even harder skill in that sense. I mean, so what do? You thought you'd get this price in 2 years, you get it in 4 months. Yeah,
we booked. So I'll be very honest, we booked profit in this as well. And it has happened in a lot of small and mid caps. So one is holding secularly for long term. And secondly, when things happen so fast, markets are, the whole psychology, a small cap, the overall flows are pretty large. And the demand, the good stocks demand in terms of supply is limited. You could see that. And hence, at times, if it's so fast, we certainly would book profit. So we don't churn aggressively, but, we do have a discipline of profit booking if anything moves so fast, That's the way as I said, we simply have an assessment of value. And while assessing that value, we do look at potential upsides. There could be some deviations, but if there is the stock prices far exceed value, we book profits.
Okay, all right. Sanjay, thanks so much for stopping by. Wishing you all the best, and we look forward to having a chat with you in the coming weeks. For the time being, congratulations on the outperformance that you've seen on your portfolio. Well, when we're having that chat with